The key difference between active and passive funds lies in how they are managed. Active funds are managed by a team of professionals who actively select and trade investments, whereas passive funds aim to match the performance of a specific market index like the Nifty 50, the Sensex, etc. Instead of actively picking stocks, they hold on to the same investments as the index they track, subject to tracking error. Let's delve deeper into passive funds. The most common type of passive funds visible in the mutual fund industry are index funds. As the name suggests, they track and replicate an index. This index could be the Nifty, the Sensex, the Nifty 500. So if you have a passive fund that tracks the Nifty 50, it will buy exactly the same stocks that constitute the Nifty 50 and have the same weightage as the index. So instead of hand-picking stocks and choosing what to buy and what not, the fund tracks and follows what the index is doing. If, say, the Nifty drops a stock and replaces it with another, the index fund will also do just that. So, will the returns from the index fund be exactly the same as the index? No. There's something called as tracking error that occurs in these funds. Tracking error is an estimate of how much the returns of the NAV of the passive fund differs from the benchmark or index it tracks. Now, here are some of the biggest advantages of passive funds. Firstly, low cost. Since the fund is simply replicating the index, it does not have very large fund management fees as there's not much research or stock picking to be done. 2. Lower human bias. Since it is aping the index, the risk of a fund manager going wrong is eliminated. 3. Diversified stock exposure. An equity index represents a wide variety of stocks. Hence, the passive fund that tracks the index will also do the same, thus reducing concentration risk and giving its investors exposure to a large chunk of stocks. Passive funds are great if you're a first-time investor and not sure where to begin, if you're a little more conservative but still want to take part in the equity markets, and finally, if you are a long-term investor. If you don't have a passive fund in your portfolio, consider adding one right away. Log on to kotakmf.com to kickstart your passive investing journey.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.